You're a special guest today. How's it going?
Going great, going great. Actually excited to be here. I'm usually behind the scenes a little bit, and I feel like this is a special treat. Normally you guys get Gary, who's a little bit better looking than me, but I'm the fill-in for today, so it's great to be here.
Yeah, we'll have Gary in a couple weeks on our normal kind of bigger look at the world and the markets and everything. But we wanted to record this pretty quickly, and Gary's retired. He's got lots of things to do, so didn't have time for us this week. But wanted to get something in when the markets were there. I just have to say, I noticed. So you're wearing a nice long sleeve shirt and you're warm, and I've got my T-shirt on. I mean, it's 30 degrees warmer here than it was 2 days ago. So,
yes.
we're good.
Yep.
It's like 21.
It's a cool 60 degrees here today. It was 45 earlier today.
Gosh.
So
life is hard.
Sunshine State for sure.
Awesome. Well, the market's been pretty cool the last couple months here, and we just wanted to record something, talk to clients about what we see, and anyone who's worked with us more than a couple months will know we're going to say, don't panic. Everything's going to be fine. Yep. But we'll show some charts and kind of walk through that. Before we jump into charts, anything you want to lead off with, Eddie?
No, yeah, it's certainly if you have money invested in the stock market, and this last couple of weeks particularly this last week has been difficult to see from a sentimental standpoint. Feeling it's never good to log into your accounts and see your portfolio down a little bit, but part of this is kind of reassuring that, hey, there is a process behind the scenes that we're going through from a quarterly, even throughout the year, as we're working throughout for you guys. And there's also a process that, hey, the money that's in this is for long-term investments. And there's historical data that points to, keeping things in a long-term perspective. So part of this is trying to separate the emotion from the actual events that are happening. And so we just kind of wanted to take the time to go through some of those things. And I think it'll be good for us to illustrate that a little bit. So
perfect. I love the way you led that off. So we're going to share my screen here. I like my charts. So we're going to start with the worst chart on the list here. And we're going to start with November 19th, 2021, not that long ago. But this is when the markets overall peaked, and primarily here's the NASDAQ. So when you see the Invesco QQQ, that's basically invested in NASDAQ stocks. You see that that's down since November, almost 15%. And this is as of the close yesterday on the 26th. Then you can see that everything, though, is down. We've got bonds are the best, and they're still down for the year. And you've got emerging markets, or still down for the last couple months, but you have emerging markets, developed, S&P 500, everything's down. We include the total stock market in here just because it includes everything. It includes every US stock that's on there, small cap, large cap, growth value, everything else. It's not been fun. And this is what we've been seeing. Let's look also, it's very similar, but let's look year to date. This is, again, as of the close on the 26th. Everything's down, and this is a correction for at least NASDAQ, but it's a correction for total stock market overall. Anything jump out to you when you look at these?
Yeah, no, it's I think one of the things that you see a lot of times is the 10% mark is hits a correction standpoint, and obviously if you're turning on the news, you're seeing some of that. It's going to affect, again, that sentiment, that feeling that you have, like things are falling and the bottom is not in and whatnot. But I think there's some of these different investments we have for folks in there. We own the emerging markets. We do have some of the large cap parts of the portfolio, and the developed markets as well. So there's a reason why we always talk about in investment meetings about having a diversified portfolio. Part of this is rebalancing when we go through and things are down, looking at options to rebalance a portfolio. So if you were just in the high tech growth stocks, yeah, it'd be a pretty scary time. But chances are, and we know for a fact that folks are not down 14% on their portfolio. So
Right.
that's why we go through the process of having a diversified portfolio of different investments in there for the purposes of having good diversification for that reason.
Absolutely. It's, the clients, we've got clients that are in their 20s all the way up to 96 and different industries, different risk tolerances. And so we kind of see it all. And the clients that have historically been more risk tolerant and have invested, maybe we've got a lot of tech industry clients. And so they hear about this every day and they saw the upside last couple of years, but they also now are seeing this huge drop here in the NASDAQ. Then we've got other clients that are maybe they're retired, they're taking money out of the portfolio, have a little bit more in bonds, a little bit less in the high tech growth stocks. And we're not getting calls from them yet, but at the same time, a lot of those have worked with me for a long time. So you've been through this before. And that's kind of the last chart we have here, which I will pull up, is just expanding out, really not that long, only expanding out to January 1st, 2020. So let me share that. So here we can see total amount, total price change. This actually does not include dividends even in this chart, but just looking at the price and how much things have changed since January 1st, 2020. Now let's think about what's happened since then. You've had a pandemic, which we've been in the whole time. You had a huge drop at the beginning, and that was really quick in terms of timing, just a couple weeks. But that happened. And then we have everything we talked about here with the last two charts since November. And with all of that, if you just stayed invested in everything except for bonds, you would be up. Now, when you throw in some interest, you're probably about break even on the bonds. They're still paying very little, but everything that we invest in has made money since January 2020 through two drops of more than 10%.
Yeah.
And that also speaks to a chart that I saw somewhere else, said from January of 2010, the NASDAQ, and that's the one that's down the most right now, the NASDAQ has dropped at least 10% 14 times in those 12 years. And yet, if you invested January 1st, 2010 and just held on to it for that time period, you'd be up almost 800%, even with this drop. And so this is just what happens every year. You should expect that we have at least a 10% correction. It's not always going to happen, and it could be two in a year, and it could be a higher magnitude, but they recover and come back. And we just need to let the portfolio do its job, which is to weather through these things. And I think you have another stat.
That's a great point. Now, so this is some statistics that came out from Guggenheim as a source, but and it went through the corrections from percentage categories, back decades ago, and for the S&P 500, 10 to 20% correction has occurred obviously more frequently. It's been about 84. It's occurred 84 times. Average
since when?
Since 1946.
Okay. Into World War II.
Into World War II. So you've had 84 times. There's been 10% corrections throughout, and it's occurred 84 times. Average recovery time is usually a month in that time. If you go back a little further, 20 to 30% correction, that's been about 29 times has occurred. And the recovery time becomes a little longer. It's about a 4-month duration for the recovery time for the 20 to 30% correction. You have a 20 to 40% correction. It's occurred less frequently, 9 months, and the recovery time becomes even longer, which is 14 months. And the point of that is to show you, hey, there has been corrections, but what you hear sometimes, like, everything's crashing, is going to be, and again, we understand and we really admit that, hey, there are going to be corrections, but if you keep a long-term view of things, there is a bump or a recorrection that the market has. And it reminds me a lot of a quote that Warren Buffett said. He goes that the stock market is a vehicle that transfers money from the inpatient to the patient. So having a long-term view is so important in this. And as we talked about a little bit earlier, there's a process we do. I mean, we go through a risk analysis, and in this first quarter, we're going to be reaching out to all of our clients and submitting a new risk analysis to kind of see where that falls. And we take that and we combine that with other parts of it, which is your portfolio allocation. And those things are really what anchor the decisions of investments. We're not reallocating or making trades based on how we feel, how the market is reacting. I mean, it's based on your risk analysis, and there's some fundamental analysis goes into that and some behavioral analysis. And then we take it, and your portfolio risk that we have allocated really dictates the changes in your portfolio. So we're taking the emotion out of it, and we're keeping the long-term view in order to have the maximum benefit for you for the growth of your portfolio for decades to come.
Absolutely. Well, and I'll add to that, in with every client, you have your own financial plan, your own goals, the own cash needs, and everything else. But when we are allocating money to growth assets, so that's stocks, real estate, publicly traded real estate investments, anything that is not defensive in nature, which is pretty much just bonds, everything else, we are allocating only money that our clients do not need for at least the next 8 to 10 years.
Yep.
So if you look at your portfolio and the stocks are down, let's just take worst case scenario, they're down 60%. As long as it comes back before you need it, you're going to be fine.
Yeah.
And it is a whole lot better if we can put you in the right allocation and let you stick with it. And that's where the risk analysis comes in the behavioral side. It is much better to do the right allocation and stick with it than it is to try to time, when am I going to sell? Is the market going to fall? It's down 15% in tech stocks. Is it going to fall another 60? I don't know. Maybe the tech bubble is going to burst like it did in the late 90s, 2000.
Yeah.
It's fine as long as you can let it recover and you can be patient. As you said, if you're patient and you actually not only not sell when it's down, but use those opportunities to buy more, you're going to be way better off in the long run. And
Absolutely.
Every single drop in the market up to this point has recovered.
Yeah.
And there's been a different reason every time.
Yep.
The story's always different. The data is a little bit different. But as long as you're a long-term investor, which is what every one of our clients is, you're going to be okay.
Yeah, no, for sure. And, kind of further that point, I read something this past week where it had the aspect of time, and it wasn't clearly defined, but it's having a long-term view. And it was along the lines of like investors who have a perspective, who think in decades, have a permanent benefit over those who think in days. So if we're watching the news, and this is the emotional side, which is very, very difficult sometimes to get out of. But if you're watching the news and you're looking at these things and you're just taking that short, kind of truncated view, it's going to be very hard to have that permanent benefit that you have. But stay invested. Compounding is magical, and over decades you'll see that the corrections and historically is proven to be true. But we've hey, let's admit we've had a up and to the right for the last 10 years with the example of some of these things. But we've had a pretty good run, and most folks are not experienced to seeing some of this volatility that's happening, and it's a normal part of the market. It's not one we enjoy, but we have to acknowledge it, but also give it its right place in the scope of everything else that's happening. And again, just want to reiterate that we're doing some of these things in terms of having your allocation, going through the risk analysis we'll be doing now again, even though we've kind of gone through that again, because this is an important part of kind of making sure your allocation is proper, and we make the tweaks when we need to do some of that. So
yeah, for those that have worked with Gary before, he's involved in the process of helping us do the risk tolerance and seeing which which is the best tool to use. And over the years, it's changed a lot. But one thing that he always said is people will answer the questions very differently when stocks are up than when the market's down. So it'll be interesting to kind of reanalyze, go through the data again. And that's not the only thing we're doing. Obviously, we're doing safe withdrawal rates for clients. We're doing RMDs for if you're retired. We're doing cash flow projections, tax projections, all those other things that are all a part of a comprehensive financial plan. Investments are only one little piece. And we're doing all that now, but just wanted to have a quick summary here and talk to clients and have something out there. Gary and I will do another in February, another one of these videos. Maybe we'll invite Eddie back. I don't know. We'll see what people say. Eddie, any closing thoughts? I think
no. Thank you. No, this has been a lot of fun. And like I said, I know it again, just acknowledging that, hey, yes, there are some concerns that you see if you're, in the feeling of it, but just want to encourage everyone to kind of keep the long-term view and same time realize that there's things that are going there, but you'll be hearing from us here shortly on some things that are kind of working towards this, and it's going to be exciting to kind of see. And I think to me it's a great time to be in the market. I mean, I'm a younger investor, so I realize that my risk tolerance is probably higher than other folks. And you have some of these dips, they're buying opportunities. You're buying more shares with more of your dollars, and that's a great thing. When valuations have been high and prices have been going up, you own less shares of the market, and you're able to own more. So when that appreciation goes up, you're going to also reap some of the benefits of the returns when they do increase, whether that's next year, 30 days from now. We don't know that, and we acknowledge that. But if you're thinking in decades, going back to that quote, you have that permanent advantage over those who think just in days. So
awesome. I like great close. And thanks, Eddie, for being here.
Great to be here. You guys will have Gary back next time. So if I wasn't as gregarious and as punctual as him, he's coming soon. So Gary, we can't wait to have you back.
We'll see. Sounds good. Thanks.
All right. Everyone, take care.